the cloud. Okay. So let's see. Now where'd my screen go? There we go. Okay, so labor force participation rate. What's it a fraction of? What's the rate of what? Yeah, so there, if you're in the labor force, what are you? Are you always working? No, so it's people working and not working or actively seeking, right? So that was to be counted in the labor force. And what are they? Who's participating? What this is like? Is this 66% or 63%? Or is it 63 people or 63 million people? So what's it a percent of? Population capable of working, yeah. So it's the working age population is the labor force participation rate. So of all the pool of people that are 16 years of age and older that could potentially be working, what fraction of that population is actually in the labor force? Whether they're working or not working, remember, because you're in the labor force, you could be unemployed. What fraction of the people that are old enough to be working, in a sense, right, that are old enough to be working, could be working? In the United States, 2008, we were at 66%, and now in 2016, we're down in the 62 to 63% range. So that has gone down. Good or bad economic variable? Bad, it depends. What's your depends answer?
If you're a job seeker, you might want to go down.
If you're a job seeker, you might want it to go down because you might have less competition. Okay. All right. Why? And who said? I didn't see who said bad. Why do you think bad?
Because maybe that just means that there's not as many jobs out there, even though there's people looking. There's not as many jobs out there.
So yeah, so some of the labor force participation stuff touches on discouraged workers, people who are like, and that's what happened during the recession. A lot of people pulled out of the labor force. They're like, oh, I've been looking for jobs, screw it, I'm just gonna stay home, right? So that person pulled themselves out of the labor force and is just not working. That could context of bad. So it is not necessarily good or bad. I agree with you, it does depend on the context of the question. You could say, are Americans workaholics, and as a society we'd be better off if we had more stay-at-home moms or dads? Would that be a better situation for our culture? Yes. Oh, well here, that's what's been going on. And so society is better at 62% rather than 66%, right? So it depends on the context of the question. It's not good or bad. It's just like many of these things, it's just the statistics. And so depending on what maybe either the objectives we have or what the circumstances are, there's some sort of story there. Okay, and then so you had the civilian unemployment rate, which you didn't graph, so minus 90%. I think rating system there. Didn't get this graph, this little thing. So 5.7 in 2004, 5.3, and then we jump into 2009, 2010, 9.8 was the peak, and now we're back down to this 4.9. So with unemployment, what is our expectation? What's good? What's bad? I think hopefully you remember from macro class that zero unemployment is not desirable. Our goal is not to get to zero. What's our goal to get to? 7%? 4 to 6? Talk to me in terms of words rather than numbers. The natural rate, what did that mean?
Just remember that's a word.
Go ahead.
People want to be working or working.
People want to be working or working in general, but we've narrowed unemployed people down to a certain type of unemployment. There's two types of unemployment that we expect in a healthy economy. Cyclical was kind of a bad one. That's not one of the ones that we want, actually. You pick the one out of the three, that's the one we don't want. Structural was one of them. What did structural mean? Businesses are changing, the structure of the economy is changing. People who are really good at fixing VCRs are currently unemployed. Is that a bad thing that we have unemployed VCR repair people? No, right? So the economy evolves over time. Some things come and go. So structural unemployment, we expect there to be some of that always in a dynamic economy that's always growing. What other types of unemployment do we expect to have in a healthy, dynamic, growing economy? There's one other buzzword. So you've done good on cyclical, structural, and nope. Kind of the labor turnover, like when the rubber meets the road, it creates friction, frictional unemployment, right? So frictional unemployment was the type of unemployment that you'd expect where somebody voluntarily quits their job, but they don't have another job lined up. That person's frictionally unemployed. The recent college graduate who throws their hat up in the air and says, woohoo, I graduated, now it's time to look for a job. As soon as they decided I need to look for a job, they just magically entered the labor force. And they are unemployed. And that's not a bad thing, right? So new entrants to the labor force, as we get some of these people who maybe were discouraged, but now with Hillary or Trump, they're very, very optimistic about the economy, and so they now start looking for a job again. Boom, they've entered the labor force, right? And so that magic moment is kind of something that we expect to have in the economy. Those are all examples of frictional unemployment. So the natural rate of unemployment is composed of frictional and structural unemployment. We expect it to be kind of that 4 to 6, kind of around 5. Economists differ on what the right number is, but conceptually that's where we're at. So if we're at 4.9%, was your data point running from August to August or July to July? Do you remember? Because they probably had it with unemployment anyway. They usually have that, you know, at a point in time. So I think you're probably close to that's a fairly recent number. So I suspect that's a July or sometime summertime 2016 number. So what's that? That was a January one. Okay. So most economists agree that we're either at or near full employment. They seem to be still trying to push it down. Again, economists disagree whether it's 4% or 5% or 5.5%. Usually 6 is a little too high. But kind of where we expect the labor market to be in the longer run, over the longer haul. Okay, good. Let's talk about somebody else's. Who else wants to show their stuff? Anybody else? Page number between 7 and 11, please. 9. 9. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Wait, you said 9.
Yeah.
9. Is that a token? All right. We go to low. Let's see. I think I need to just go back. Oh, I did. Oh, yeah, right. All right. On your Fred. Oh, by the way, where did you get that data, Paige? The Fred? Okay. All right. So, Logan, what do you got going on here?
I did percent change in GDP for several different countries.
Okay. Interesting. So let's see. We got what do you got? United States, UK, and China, and you've got it in percentage changes. What does that mean?
So the percent change is how it changed relative to the year before.
Okay.
And it's from each year is from January 1st.
Each year is from January 1st. Okay. So from year to year change, new number minus old number divided by number, what's the percentage change, right? Where's Logan? Oh, there. The bright light was getting me on here. All right, and so you did that from each one of these.
Yeah.
So we had some negative numbers. So we've got our the UK and China dipping negative 2009, and so this is the United States.
No, that's China.
Oh, that's China. Okay, so this is US. All right, so which one? What color is you? Oh, here we go, blue.
Right there.
So that was the blue with the recession. So we see the percent change. What is the needed drop in GDP for a traditional measure of whether it's a recession? How long does GDP have to be slumping for the government to deem it a recession in technical terms? By the way, kind of new recession terms have come up over the years, but what is the top? Does anybody remember that from macro class? 3/4 is a little strong. 2. So 2/4 decline, 6 months. So if GDP has been falling for 6 months, we're in a recession. And so that was part of this dip here would have been a full year or so during that 2008 time frame. All right, so interesting, good. 1, 2, 3, 4, 5, 6, 7, 8, 9.
I thought I had to.
Did you do it?
I printed it out.
Oh, you did the printout. Let me see your printout.
It's not right. I thought it was due by. I mean, I wrote due by.
Did it? So you screwed up, is what you said. Yeah. Okay. Got it. Let's see here. If I can pull this off. Let's see. Stop the share. All right. So what'd you do? What was your data?
I had.
Oh, you don't have any graphs.
I know.
It's upside down.
I screwed up completely. Out.
Okay, screwed up completely. All right, we're gonna move on to the screwed up completely. All right, 1, 2, 3, 4, 5, 6, 7, 8, 9. Logan again. 1, 2, 3, 4, 5, 6, 7, 8, 9. Tyler, what'd you do?
Mine on the U.S. and capital investment savings and investment.
Okay. And you emailed yours in, right?
Yeah.
There it is, Tyler. Okay. Bing. Let's see. Okay, you got your data up front there. So you did it on GDP spending percentage of GDP. Okay. And I can't quite. There we go. All right, and what was the percentage? So this is government spending as a percent of GDP?
Yes.
And what are the multiple colors?
Well, it says at the bottom. I'm not sure.
Oh. Let's see, I can choose. Oh, there it is. Okay, got it.
One of them is
Let me shrink this thing down, this one. There we go. Okay, so you got capital investment as a percent of GDP, savings as a percent of GDP, and government spending as a percent of GDP. All right. So government spending going up. So what do you think's going on with somebody other than Tyler? What's going on with this graph over this time frame? Does that make sense?
Buyouts.
What's that?
The buyouts.
Some of the buyouts, some of the bailouts, some of the increases in government spending anyway, right, as a fraction of GDP. So as the economy goes, if we look at that statistic of government spending, G as a fraction of GDP, this is the statistic, right? Government spending in dollars over GDP. GDP is equal to our cigarettes. C plus I plus G plus X. This was the expenditure approach to measuring GDP. GDP is equal to consumption plus investment plus government spending plus net exports. And so you've just simply taken G as a fraction of GDP, right? And so as we go through this recessionary time frame, what's happening to GDP? Going up or down? Down. And then what's happening to government spending with more people on welfare and unemployment and everything? It's going up. So we got the numerator going up and the denominator going down, leading to what happening with the overall fraction. Overall, this thing's going up. Got to be going up. And that's what we see in the data. So we got this little blip as a fraction of GDP over time. All right, and then you've got capital investment as a percent of GDP. Are people buying new machines and everything when the economy's in a free fall? Not so much new investment going on in the economy, so that one kind of makes sense. Savings as a percent of GDP. People are not saving their money and their income. They're trying to supplement, so savings reduction. So all that kind of tells a story with our recession. Okay. Did anybody do interest rates of any sort? You think you did? Okay. I didn't look at your stuff. This is my reveal time, so I don't know what you guys did. By the way, I wasn't able to do it at the time, but I would like you to upload all of your work to Blackboard when I have a folder for it, so it'll all show up there. They just got that edited. All right, so Kaylee, where are you? I just tucked you guys all into a folder here. All right, good. So what do you got? Credit card loans, automotive loans, and personal loans, some sort of average interest rate? Is that what you got going on?
Yeah, I think so.
All right. Get this little guy out of the way. Okay. So personal loans, automotive loans, credit card loans. So by looking at that data, how do you interpret what goes on with those three types of loans? They're very similar in what respect? So just tighten up the language. I don't want you to just say, oh, they're similar. Well, that could mean a lot of things. Similar with what? What's similar about them?
One falls, the other falls.
Yeah, they're moving together. So and we don't want to think about causation, but they're correlated with each other, right? So the movement is what's similar. The movements are similar. So at a given time frame, they're both falling together. So these interest rates on different types of loans tend to move together. Credit cards being the higher rate, automobile lower, personal loans somewhere in between. And all of these are unsecured, whereas this is a secured credit. So does that make sense that the interest rate on an automobile loan would be lower? Why? What's driving automobile interest rates to be lower? It might be a bigger loan. You might have a $30,000 loan on a nice car as opposed to a $5,000 credit card. So less risk. Why? Because you can take the car back. Yeah. So in all of these cases, the risk goes down when the lender has a chance of recovering something. So with house loans and car loans, those are known as secured debt obligations. Secured debt obligations. Whereas these fall into the unsecured category. So things securing that it's just your signature, your promise to pay. So if you go bankrupt, you can get out of all of these. You can get out of all of these. But even if you declare bankruptcy, the bank still has dibs on your car. You don't get to keep your car. It still goes back, right? So bankruptcy will get you out of all of these loans. The one that might have been interesting would have been student loans. And student loans would fall down here. Now, student loans, is that a secured loan or an unsecured loan? Secured loan or unsecured loan? So if it's secured, what is it security? What is it secured by? Okay, so that's one part of it. Bank can't bankrupt out of your student loans. So that's one element of it. So is the student loan secured or unsecured debt for the consumer, for the student who took it on? Is it secured or unsecured? So with secured, you just have to ask what's backing it, is kind of the simple thing. Do you have any assets that are securing your student loan debt? Do you have any assets in your portfolio, besides this one, that is covering your loan? Answer, probably not. Now, I think there might be some hybrids out there where your parents might have pledged their house as part of your student loan, which wouldn't be a good idea. That would be unusual. Usually that would have been just some sort of home equity loan, so it wasn't probably a true student loan. But I wouldn't doubt if there's some loan products out there where the banker allowed you to get your student loan if your parents pledged some of their house to it or something. That's a possibility, but for the most part, they're unsecured. Is the lender who has it in their portfolio secured by anything? So now I'm switching hats on you. So does the lender have any security in the student loan?
If you were to get a job, you would punish.
No, that would be only through a judgment. So yes, they could, but if you declare bankruptcy, well, not in the student loan case, then you would be. But and that gets back to the they have a little bit more security, but they may never get paid. You might die before you actually get paid. And if you died penniless with nothing to your name, they never get paid ultimately. So there is no other asset that's securing it other than your signature. But if the lender has a whole bunch of students, let's pretend that People's Bank here in town has all of the student loans on their portfolio. Do they have any security if people default? If they're government-backed student loans, then the government is backing the deal. So if you quit paying, the government will pay the bank on your behalf. Now you're going to have a problem with the government, though. And that's why the government doesn't ever stop on you. You can't avoid death, taxes, and now student loans too. Because if it's a federally backed student loan program, then ultimately that's going to be partially insured or fully insured for the bank. And that's why they're cheap, because the banker can give you a cheap interest rate knowing that Uncle Sam's going to bail you out, and they'll at least get paid. Uncle Sam will take the responsibility to chase you to your death. Because you can't bankrupt out of student loans. It's nice when the government carves out little things in their policy laws that protect them. It's like, oh, well, if it's my money, then, and really my money is somebody else's money anyway, but we don't have to get into a big theoretical tax deal. Okay. So any other interest rate ones that were different than Kaylee's? I don't want to put up any more similar data. I think that was a good discussion. We kind of hit some different things. Was everybody comfortable with using Excel? I got some of your emails back that you weren't, or that you didn't quite get it totally. But Excel's a good to have for data manipulation, and we might have a few more exercises, but I wanted to get you comfortable with taking data from a website, transferring it to Excel. Again, some of them were easier than others if you could just export to Excel and then boom, and then create the graphs. But something that you should know, really regardless of if you're, I'd say these are skills that we'd like all business majors to take into the workforce. So regardless of whether you're econ, accounting, or finance, this is something your employers will want you to do. Trust me, you will look better in the job market if you can pull off some of this stuff. So come and see me if you did have problems or if you want to review it. Otherwise, it's mostly a bunch of farting around with it, right? But once you get it, then it becomes a little easier getting the labels and making it pretty with colors and all that stuff. And for the most part, they'll get team have made it pretty easy for us. Okay. So, okay, so today I want to bring up a couple hot topics in finance that we've seen in some other classes to maybe a more limited degree. And that is moral hazard and adverse selection. Was it just Derek that's had investment finance? Did anybody else take investment finance yet? He kind of took it out of order because he's trying to get out of this finance, so he had that last time. So Derek, pressure's on. So financial markets can help us alleviate some problems of asymmetric information. Asymmetric information. I think I missed an M. Asymmetric information. What does that mean, first of all? Asymmetric information, as it deals with kind of a buyer and a seller. We're thinking about a marketplace where somebody's buying something, somebody's selling something in some respect.
Like if you were to buy something, it won't be priced from one person to another, they might.
Possibly, but that's not really hitting the information category. One party knows more than the other. There's not equal information. So if we have symmetric information, both the buyer and the seller have equal information, right? There's equal information on each side. So whenever we see this A word, like amoral, it means that it's not, there's no morals with it, right? So it's amoral, like morals, that it's not that it's evil, it's not that it's saintly, it's just amoral. That doesn't apply to it. So asymmetric means it's not symmetric, so it's without something. So it's without the symmetry. Have you guys ever heard of what makes a beautiful person beautiful? Like in general? There's been some real studies on this. What's that? The face symmetry, that's right. So the symmetry of the face turns out to be something that they've done studies on with psychology and other things, that if your left half of your face kind of is really symmetric with the right half of your face, then you are likely beautiful. But if you've got like a little wart over here or something like this, see how that makes me ugly? Even though I'm normally beautiful. Now if this was over here, then all of a sudden that's pretty. Right? So if both sides of the face are the same, then people tend to, that's where part of where beauty lies. So, all right, so asymmetric information is in a marketplace, there is not equal information on both sides of the transaction. So if we bring this down to kind of econ lingo, we're talking about transactions, so it's the buyer and the seller not having equal information. All right, and so there's two broad topics within asymmetric information that end up being pretty important for market behavior. And one of those is moral hazard. Moral hazard. So, moral hazard is a post-contract problem. Post-contract problem. And if you don't anticipate moral hazard, then you could bigger problems down the road. So if we put this into a lender-borrower concept, suppose that you're doing a construction of a building, and you've got a loan, and the lender is able to allow draws. So you've got $1 million property, you're going to get $1 million loan. After you've signed all the loan papers, how might your behavior change a little bit when you go to build the building? What are some moral problems, and they call it moral hazard for a reason, because it's kind of like, it's not the most moral thing to do. Cut corners might be one thing, right? So maybe you start cutting corners with costs and still submitting the full bid. So you did $100,000 worth of work, but you didn't really do a full $100,000 worth of the work, right? And so you might be showing a building that is 20% complete, but in reality, you've only done about 10% of the work, right? So your behavior changes post-contract because one of your incentives is to maybe get money sooner than later. You'd rather have more of that construction draw sooner than later. So that's an example of moral hazard in a construction loan problem. So the key here with moral hazard is that there's a change of behavior, that works against the agent with less information. So another example would be the all-you-can-eat buffet restaurant. How many people tend to eat a little bit more than they even want to or should at the all-you-can-eat buffet? That's moral hazard. Now you might go in, how many people got into the buffet and said, all right, I know it's all you can eat, but I'm not going to stuff my stuff. I know I feel gross after I do that. I know that I need to lose weight or whatever. And still you fall into that trap when you get in there, right? So that is moral hazard. Post-contract, meaning you've already paid the ticket price to go to the buffet, right? You paid the ticket price to go to the buffet, and once you're inside, you tend to overeat. So post-contract, our behavior changes. All right, questions on moral hazard? The other key one is adverse selection. Adverse selection. And this is pre-contract. Pre-contract problems. And if you're, let me just hang with the restaurant example for a second. If you're thinking about opening up a restaurant and you're thinking about, maybe we should just do a buffet. There really isn't another, buffet in town. And so, if I did some data, I did some market research, and I found that the average person consumed, 1.2 pounds worth of food. And on this amount of food, I look at the averages on a given meal. That's about what I should run. So what's true that could be a problem of opening up our restaurant in terms of the type of people we might attract? Who are we going to attract to our restaurant pre-contract? Hungry people. People with big tummies. People with big appetites. People who go beyond the average plate size. If the average person consumes 1.2 pounds, for some reason, oh, I don't know why, but we seem to be attracting people who eat 3 pounds of food, right? And so we've underestimated the cost of running a buffet business, right? Because we didn't think about what our policy is going to do and who we're going to attract. Who we're going to attract. We're not going to attract the average Joe. We're going to maybe tend to attract big eaters. So the pre-contract problem is adverse selection is a problem with who is drawn to my business. Problem with who is drawn to my business. If I go back to the construction loan idea, if I have come up with ways, I'm a new bank in town, and I'm aggressive to getting some new business. I know it's kind of hard for me to compete with Wells Fargo and some of the other bigger players in town, so I'm going to offer really low application process, lower interest rates, to try to get business, right? Who am I likely going to be attracting to the bank? Lower income, right? More risky type of people, right? People with higher chances of default than the average Joe. And so if I'm not careful with that, I'm going to attract risky borrowers to my bank rather than the average Joe. So I'm playing a game with a portfolio where I think if I have 1,000 customers, you know, some of those customers are going to default, but it's kind of a random shot of how many of those are going to default. But if instead I have something set up so that I'm attracting risky people to my bank, then I'm going to have lots of defaults. And I might have default rates that are higher than what the average is because of this adverse selection problem. The people who are applying to my bank, back to asymmetric information, they know they're risky. They know their behavior, right? They know that, oh, this is kind of a long shot, but I heard that new bank in town is up for doing business. I'm going to go to them, right? And so I'm going to be attracting potentially those risky people. So, so let's just put for our examples here. Buffet attracts big eaters, right? So the fact of the way our policy of how our business works, all you can eat buffet, one price, $10. Buffet attracts big eaters, and then it could be that a new bank attracts risky borrowers due to the way they have their policy set up. If you anticipate these problems, it'll likely not be something you can't overcome. You just have to change your pricing. If you're running a buffet and you anticipate adverse selection, instead of pricing things at the average plate consumption of $10, you know that you need to price your meal at $12, right? So price can overcome this. It only becomes a problem when it's asymmetric. If you start to know that that's the type of people, the price can accommodate for that. Same thing with the banks. Risky borrowers should have higher interest rates, right? The insurance game is probably the best example of all of these. So give me an example of moral hazard as it relates to car insurance. Moral hazard as it relates to car insurance. I think I'll go to the random number generator for this. Who did I leave off with? Tyler? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9. Sorry. You were next in line.
Well, like for like the person buying the car or buying the car insurance, you know.
So after you get your insurance policy in place, what would be an example of moral hazard?
You know that you're like a risky driver. So then.
You're sounding like you're starting to go on to adverse selection. Let me give you a shot on if you have an insurance policy that's full coverage, and let's say a very little deductible, and you're not worried about future changes in your policy. Does that, when you're driving home and you tend to be liking speed, are you really careful, or are you not quite as careful because you got insurance anyway? Are you always really as careful as you would be without insurance? That's another way to look at it is, do I drive more careful when I'm without insurance or with insurance? When do I drive more carefully? When I don't have insurance or when I have insurance? Yeah. How many people know people who have lost their license due to DWI? How do they drive when they drive illegally? Like grandma, right? Who's following the speed? Anybody who's following the speed limit around town, you know, oh, I bet they got a DWI. I bet they lost their license, right? That person is following every law. Hands are at 10 and 2, right? You're driving the speed limit, you're looking around, you come to a stop sign, better make a full stop, feel the motion of the car go backwards. No California rules, right? Am I right? The person who's driving illegally uninsured is much more careful with their behavior. Whereas the person, once they get insured, is like, oh, if I get into a wreck, it'll be covered. You know, I can handle it. I got to pay my deductible of $500, but everything else will be covered. And so you do the California roll, you're texting. There's not any law against texting, is there? Did they change that law yet? Oh, screw it. Yes, I'll be there. I'll try to use the voice control. So you're texting, you're doing all that stuff. That's moral hazard here. The adverse selection story is potentially with the insurance contract. Who are we attracting? We might be attracting the risky people to our place before we do it. So we better have our insurance priced knowing that we might be attracting risky people. All right, let's call it a day there. We'll see you on Friday.
Yeah.